Jamie Dimon has warned that high inflation and high interest rates are here to stay. In his recent letter to shareholders of JP Chase & Company, the billionaire CEO shared his concerns about continued high prices and stated that a combination of inflationary forces could push US interest rates to 8% or even more in the coming years. This would mean interest rates far above current levels, which already represent a 22-year high and going against conventional expectations of rate cuts in 2024. In his words, huge fiscal spending, the trillions needed each year for the green economy, the remilitarization of the world, and the restructuring of global trade, all are inflationary. In Dimon's view, investors are being overly optimistic about the economy's ability to bounce back from such challenges as persistent high inflation means the likelihood of a soft landing for the economy are, in his words, a lot lower than the consensus of 70% to 80%. Dimon also warned about the potential for carnage for both equity and debt investors should a higher rate scenario play out, noting stock valuations are already at their high end and credit conditions are extremely tight. In this video, we'll cover why Dimon is so worried about high inflation and high interest rates, what this means for the economy, and the strategies you can follow to protect and grow your money during such economically challenging times. Stick around, as the last one may surprise you. But first, why is Dimon so concerned about inflation? The CEO of JP Chase has expressed concerns that high inflation may persist due to several factors. One of the main reasons he provides is excessive government spending driving up prices. Dimon's remarks come following the US Central Bank, the Federal Reserve, supplying trillions of new dollars into the US economy over the last few years in an attempt to prevent a widespread economic disaster following the coronavirus pandemic. The Fed's goal was to keep markets functioning after they were spooked by the global pandemic by promoting economic growth and making debt cheaper. This worked in the short term and prevented an economic collapse. But one of the major downsides of supplying more money in the economy is inflation. When the government injects more money into the economy, it can lead to increased demand, which can drive up prices. To explain this relationship, let's take a look at this simple demand and supply chart. Supply in the overall economy is denoted by the AS line, and demand in the overall economy is denoted by the AD line. Now let's see what happens when demand increases. The demand curve moves out to AD2. At this new level of AD2, prices on the y-axis have increased, along with the real GDP or output of the economy on the x-axis. When demand outpaces the economy's ability to produce goods and services, it can lead to something called demand pull inflation. Companies may respond to increased demand by raising prices, leading to inflation. Government spending is often financed through borrowing or by creating new money, printing money. If the government borrows, it competes with private borrowers for funds, potentially raising interest rates. If the government resorts to printing money, it increases the money supply directly, which can lead to inflation by devaluing the currency. Inflation can then spiral in the economy, as higher prices mean higher input costs for businesses. Higher input costs for businesses mean they produce less. Take a look at the same demand and supply chart. On our chart, the supply curve or AS curve moves inwards to AS2. This shift represents a drop in supply which, as you can see, results in higher prices and reduced output. Businesses have to pass on these costs to their consumers in the form of higher prices, something that is known as cost push inflation. Before we see how inflation is impacting the economy right now, please don't forget to click the subscribe button if you want more weekly updates on how to build massive wealth, even in market downturns. Okay, back to inflation. Since suffering high inflation in the 1980s, the US economy has enjoyed nearly 40 years of low and stable inflation, close to the Fed's target rate of 2%. This chart shows inflation in the US economy over the last 60 years. Following the Fed's effort to stimulate the economy after the pandemic, the Consumer Price Index rose 6.8% between November 2020 and November 2021, driven by price increases for gasoline, food, and housing. Higher energy costs caused inflation to rise further in 2022, reaching a high of 9.1% in June 2022, a high not seen since 1981. As you can see, inflation has declined since then, but it's still at a level that's higher than we've seen in the US for over 10 years, and is taking much longer to fall than many expected. And Jamie Dimon has warned that the combination of high government spending and the need for increased spending on transitioning to a greener economy, restructuring global supply chains, boosting military expenditure, and battling rising healthcare could keep price increases sticky, causing something known as stagflation. Stagflation is a term used to describe a situation where an economy experiences stagnant economic growth, stagnation, alongside high inflation and high unemployment. This combination of economic conditions is considered unusual because conventional economic theory suggests that high inflation is typically associated with strong economic growth, while high unemployment is associated with low inflation or even deflation. Stagflation is a real concern for an economy because it can have a number of negative impacts. Firstly, it can erode the purchasing power of wages and savings, leading to a decline in real incomes. This can cause consumers to cut back on spending, which can weaken economic activity and create real uncertainty for businesses, as high inflation means their goods are costing more to produce and supply to the market. But high inflation also means that consumer spending is low and uncertain. This makes it very difficult for businesses to plan for the future. The uncertainty can lead to reduced investment in new projects and increased cost-cutting, further dampening economic growth prospects and potentially leading to high unemployment as jobs are cut to save costs. So, what can be done to try to tackle this inflation problem? One of the key tools available to central banks to keep prices under control are interest rates. Put simply, interest rates are the price of borrowing money. When interest rates are low, it's cheaper to borrow money for things like buying a house or starting a business. But when inflation starts to climb, a country's central bank, like the Federal Reserve in the United States, might decide to raise interest rates. They do this to slow down the speed of price increases, as higher interest rates make it more expensive for people and businesses to borrow money, discouraging consumer spending and discouraging companies from taking on debt to finance expansion. Higher interest rates also make saving more attractive, further reducing consumer spending. This can help keep inflation from getting too high. And it is for these reasons that the Federal Reserve has aggressively increased interest rates in recent years to their highest levels in 20 years. As you can see from this chart, after 40 years of declining or almost zero interest rates, the Fed has been increasing interest rates since early 2022, with significant increases in December 2022 and early 2023. Currently, the Fed funds rate stands between 5.25% and 5.5%, matching the highest level since 2001. And Dimon warns that thanks to sticky inflation and the potential for stagflation, interest rates could rise even higher in the future, to as high as 8% or even more. As Dimon put it to shareholders, beware of higher rates and recession, not just for banks, but for the whole economy. To put that into context, you'd have to look back almost 35 years to 1990 for the last time interest rates were as high as 8%. And Jamie Dimon warns that the economic stagnation that will result from these higher interest rates could push the US economy into a recession. Dimon believes that the Federal Reserve's policies and the current economic data suggest that interest rates may remain higher than expected for longer. He believes that the odds of achieving a soft landing for the economy, which would involve modest growth along with declining inflation and interest rates, are lower than what the markets are currently pricing in. So how can investors protect themselves against high inflation and high interest rates? Strategy 1. Use equities as a hedge. Jamie Dimon suggests equities could be a viable investment during high inflation periods, as companies with the ability to pass on higher costs to consumers might offer better returns. These include companies in sectors such as utilities, consumer staples such as food and beverages, healthcare, and natural resources. To understand this, let's take the example of two fictional companies. The first is a cleaning products company called Clean Sweep Solutions. The second is a fashion retailer called Vogue Avenue. Clean Sweep is a leading manufacturer of household cleaning products such as laundry detergents, disinfectants, and soaps. Vogue Avenue operates retail stores across the US and has a strong following for its niche fashion items. Now let's say that inflation in the economy is at 5%. This means that both Clean Sweep and Vogue Avenue's input costs, such as raw materials, manufacturing, and transportation, are all 5% more expensive than they were this time last year. For Vogue Avenue, this potentially spells disaster. Like most retailers, it already operates with thin profit margins, and significant cost increases, such as rising transportation costs, can squeeze margins further. As its products are high fashion items, its customers are highly price sensitive. When prices are high, consumers are less likely to purchase such items as they redirect their money to cover more essential items like food and fuel. So, if Vogue Avenue tries to pass its higher input costs on to consumers, they simply wouldn't buy the products. As a result, Vogue Avenue has to eat the extra cost, directly impacting its bottom line, meaning less profits are available to pass on to its shareholders, lowering its stock price. However, Clean Sweep is in a much better position. It knows that its customers are relatively price insensitive because people still need to clean their homes and their clothes, even during periods of high inflation. As a result, Clean Sweep can increase its prices to combat inflation, safe in the knowledge that its customers will still pay. As a result, Clean Sweep continues to thrive and make high profits, which is reflected in its higher stock price even during periods of high inflation. This example illustrates why not all equities are equal during periods of high inflation, and why you should look to focus your investment on those sectors that can pass higher costs on to consumers in the form of higher prices. Strategy 2. Focus on strong fundamentals over the long term. During a market crash, prices may be depressed, but the underlying value of quality companies remains intact. So, when the market crashes, you should focus on the value a stock represents rather than its price. To do this, you need to look to invest in companies with strong fundamentals, sustainable competitive advantages, and attractive valuations. These are the kinds of companies that can weather an economic storm and emerge stronger on the other side. One of the key reasons why investing in value is so powerful is because it encourages a long-term perspective. Unlike short-term traders who focus on timing the market or chasing after the latest trends, long-term investors take a patient and disciplined approach to investing. Instead of worrying about day-to-day fluctuations in stock prices, long-term investors focus on the underlying fundamentals of the companies they're investing in. They look for businesses with strong competitive advantages, consistent earnings growth, and attractive valuations. And they're willing to hold on to these investments for years, if not decades. By focusing on buying quality assets at bargain prices, maintaining a long-term perspective, and capitalizing on market inefficiencies, long-term investors can potentially generate superior returns and build a more resilient portfolio over time, even during an economic downturn. Strategy 3. Buy commodities. One of the best assets to invest in to provide great protection against the effects of inflation are commodities. Commodities are raw materials either consumed directly or used to manufacture finished goods. Examples of commodities include gold, silver, oil, and even soybeans or coffee. Generally, the demand for commodities tends to be high during periods of high inflation, which pushes up commodity prices alongside rising inflation, preventing inflation from eating away at your investment returns. You can invest in commodities by directly purchasing them. For example, buying gold bars or barrels of oil. However, when you directly purchase commodities, you will need to physically store them. Not only do they take up a lot of space, there is also a risk they can get stolen, lost, or otherwise spoiled. Fortunately, there are much simpler ways to invest in commodities, such as futures contracts, commodity stocks, or investing in commodities through a commodity ETF. As Jamie Dimon expects inflation to stick around in the US for quite some time longer, commodities remain an excellent choice of investment to benefit from price rises. Strategy 4. Consider Treasury inflation-protected securities. Tips. The bond market is where people lend and borrow money. When you buy a bond, you're lending money to the government or a company, which promises to pay you back with a little extra in the form of interest. But when inflation goes up, the bond market faces some challenges. Given the current high inflation environment, this does not sound so encouraging. But the good news is there are ways to use the bond market to get rich, especially during inflation. One strategy is to invest in Treasury inflation-protected securities, or TIPS. TIPS are bonds issued by the US Treasury that are indexed to inflation. This means that the bonds increase their payouts with inflation, helping to protect your money. When inflation rises, so does the value of a TIPS investment. TIPS pay a fixed interest rate on the inflation-adjusted principal. This means that not only does the base value increase, but since the interest paid is based on the base value, the interest payments increase with the base value increase. This provides investors with both inflation protection and income. Direct investment in TIPS can be made through the US Treasury or through a brokerage account. They are also held in some mutual funds and exchange-traded funds. Strategy 5. Diversify your investments. Diversifying your investment is equally important. It means spreading your money across different types of investments. Instead of putting all your eggs in one basket, you place them in several. This way, if one investment doesn't do well, you have others that might be performing better. You can diversify your investments in many ways. This includes investing in different industries, different types of assets, and even in different countries. This strategy helps to reduce the risk of losing money and can lead to more consistent growth over time. This is why, in his letter to shareholders, Jamie Dimon emphasizes the importance of a well-constructed portfolio and advocates for diversification to withstand various market conditions. But remember, diversifying doesn't mean investing in anything and everything. It's about making informed choices based on research and perhaps advice from financial experts. Also, you'll never eliminate risk completely. Any investment can go up or down in value, and you could make or lose money. The key is to find an appropriate spread of investments and a level of risk and return that you are comfortable with. Strategy 6. Invest in art and antiques. This might not seem like your typical investment strategy, but investing in art and antiques can provide a very effective hedge against inflation. And it's not just for the super rich either. These days, anyone is able to invest in art, and we'll show you how. Firstly, fine art is considered a strong investment during periods of high inflation because it is a great store of value. Fine art has historically retained its value over time, even during economic downturns and periods of high inflation. It is not correlated with traditional markets. Art often has a low correlation with traditional financial markets, meaning it doesn't necessarily follow the same trends as stocks and bonds. It holds sentimental value. The value of art is not solely based on intrinsic worth, but also on sentiment, rarity, and the artist's reputation, which can remain high regardless of economic conditions. It has potential for appreciation. Art prices have historically increased during periods of high inflation, offering the potential for good returns. In fact, fine art is known to clock returns of up to 300%, far outperforming the S&P 500. These are all reasons why billionaires like Jeff Bezos and Oprah Winfrey invest in fine art to grow and protect their money. Now at this point, you may be thinking, that's all great, but I'm not a billionaire. How can I afford to buy fine art? Well, as I mentioned earlier, fine art is now available to any investor thanks to the availability of art funds. Art funds work similar to mutual funds, except instead of investing in stocks, the fund invests in pieces of artwork. You can invest in art funds on sites such as Masterworks, a leading art fund with over 800,000 members invested. The fund is managed by professional art advisors and fund managers who select and acquire artworks based on research and expertise. The art fund then pools money from multiple investors to purchase artwork, charging a management fee to investors, similar to a mutual fund. The fund will then have a strategy for selling the artwork with the goal of realizing a profit for its investors. The scarcity, uniqueness, and cultural significance of fine art makes it an attractive investment for individuals seeking to diversify their portfolios and protect against inflationary risks, so it's worth checking out. And there you have it. The reasons why Jamie Dimon is so worried about high inflation and high interest rates, and the strategies you can follow to grow your wealth even during such economically challenging times. If you want to learn more about how you can maximize your investment opportunities during a recession, head on over to this video where I show you just that. Thanks for watching, and until next time, keep building your wealthy life.